Good.
Yes, sir.
Okay. So yeah, I don't know how many folks in chat. I guess everybody in chat probably sees my channel, but I know Harry's calling out a lot of spreads too. But I wanted to take the time to run through why I switched around some of my trading from just trading like naked positions to trading spreads, and then the rationale behind it, kind of what you can do. So hopefully people understand better exactly what happens when you run spreads and what the risks are. So this is a great quote from Option Alpha, from the guy that runs that. If you guys haven't seen it, he's a very conservative trader. He does mostly selling credit. But really, when it comes down to strategy, you're choosing the option strategy, or you're not choosing the option strategy. It's a process of elimination when you're looking at each trade and each setup. So, and I'll kind of explain that a little bit when we look at these. So we're not crawl, walk, running. We're just running for options 101. So when you just look at naked long options, if the stock price is going up, you're buying a call. If the stock price is going down, you're buying a put, right? Um, but this is obviously a lot different from trading just the underlying stock because you have to also not only get the direction right, but you have to get the time right because you're buying a certain expiration where these options are no longer going to be worth anything. Uh, so when we look at this, uh, the um, the naked long options, right? That's jacked up. Uh, if the stock price is going up, there it is. You buy the call, which essentially you're looking at this thing, right? You've got to not only get the direction right, but you've got to get the timing right. So if you think in 3 weeks it's going to be at the 50 and you buy the 50 level option and it just kind of comes down in here and it never gets up to that, you're going to lose. So if the stock price is going down, you buy the put. And if it just bounces off of this level and kind of comes up, you're losing. So pretty obvious. If you're selling options, you get a little bit more leeway with this, right? If you think the stock price is going up or sideways, you can sell a put. And if you think the stock price is going down or sideways, you can sell a call. And so that gives you a little bit, a little more ambiguity with the trade. So it eliminates some of the complexity by picking the direction. But at the same time, you add a lot of risk when you do that. So um, for your directional move, you really only have to pick the maximum directional move and the rough timing because theta when you're selling options is on your side. So we look at this again here at Neo, right? If you are bullish on this and you think that it's going to catch support at this 40 level, you can sell options down here at the 40 level, and then so long as it does this or goes up, you're good to go. If it starts breaking this line down in this area, then you can get into you're going to start losing on that trade, right? When you look at the option price, if you're bearish on the trade, right, you can sell a call, and if you think that it's going to come up into this area but not breach it, you can sell a call up at like the 55 level somewhere in there, and so long as it comes up and doesn't breach that, does this the whole time, you win. And even if it goes completely down on this trade, you win on that also. So you can spreads basically combine the best of both of these worlds, depending on how you build the spread out in the strategy, right? So that's what we're going to talk about today is trading spreads. Um, so you guys have obviously heard of the Greeks, and we're going to actually go there because it's important. If you've ignored it this long and you're still trading, you definitely have to take a look at some of these things. And this is what helps you figure out your trades and your risk calculation. So before we go to the Greeks, we'll talk about implied volatility. And implied volatility is a calculation used to estimate the potential mean deviation of a stock. And that simply means over the last 24 months, 12 months, whatever, that stock has a certain range of movement. And if it's moving more than that range, the IV will wind up being high for the time period. And if it's moving low than that average range, it's going to be lower. And so you've heard of this IV crush or contraction. And you've also heard people say, "Oh, that the IV on that ticker is way too high," or "Oh, the IV is low on this ticker." But IV is relative, right? So if you look at Tesla's like always at 150% IV. So that's pretty normal for Tesla. So you have to look at the IV percentile, which you can pull up on any brokerage and see where it is trading at. So if the IV percentile is saying like 50%, and then the IV percentile is 50%, but IV is at like 180. Well, that's right about in the middle of the range. It can go up to 360 or down to, probably nothing goes down to zero, but it'll go down to say 20s or 30s. So that's what you have to look at when you're trading something. What's the IV percentile? And you can also compare it to the historic IV. Like if the historic IV is 58%, that's an average of the move that it typically makes over the last 12 months, typically. And if the current IV is, say, 75%, you know that it's a little higher than it usually is. Right. And if you're not familiar with the Greeks, um, theta is the value is a contract loses each day that passes, and that includes weekends. And delta is the dollar amount a contract changes with each $1 of underlying movement. And then vega is something that a lot of people don't look at, but that relates exactly back to the implied volatility. So vega is the dollar amount a contract changes with each percent move in IV, up or down. All these are, except for theta. Theta is the only agnostic Greek. Theta goes down no matter what on options, unless you're short the options, and we'll explain that. Gamma is the dollar amount that delta changes with each $1 move. And so this is where you get into some really interesting things with calendar spreads and diagonals. So quick terminology on this that you might have seen in my channel already. Buy to open, BTO. This is a debit trade. So you're paying to open a position. This is what we're doing with naked positions all the time. Selling to open a position is a credit, and you can do this naked, like we mentioned earlier, or you can do this as part of a spread. You're going to buy to open one and sell to open another. If you buy to open, you sell to close, right? And you should receive a credit if it's a winning trade. If you sell to open a credit, you will buy to close it, and it should be a debit. But the difference with this is that you should be able to um, you should be paying less for it than what you sold it for. So we'll get into that a little bit too. But this whole brief is mostly focused on debit spreads. Okay, I believe before you're starting to sell credit spreads, you should understand debit spreads a little bit more than you should understand debit spreads very well before you start trading credit spreads. When we talk about calendar spreads and diagonals, we'll say front month contract, which is just the option contract with the shorter expiration, and the back month is the option contract with the longer expiration. You've probably heard a lot of these terms here: long call spread, short call spread. These are also called bull call spreads, vertical call debit spreads, bear call spreads, vertical call credit spreads. So that's what I showed you on that first chart was if you're bullish on a stock, you can buy a long call spread. If you're bearish, you can sell a bear call spread on it or a credit spread. And then long put spread and short put spread. These are all just the same names for different strategies. So this is one of the biggest fears that people have when they're trading spreads is how do I know I'm not getting into trouble with this? Am I buying or selling this spread? Because you can have a lot more risk selling spreads than you can buying them. You 100% define the risk when you buy a spread. Like on this Neo example, this is a debit, and all brokers show this. Some do it better than others. This is actually a screenshot from Weeble's app. So this is a debit. You are paying, and they show it in red. You're paying $40 for this. So when you go buy something at the store, you pay for it, right? This is the exact same thing. You're paying for this. When you do a debit spread, you are buying the better. I don't know why it keeps doing that. You are buying the better spread or the better contract, and then you are selling somebody the less valuable contract. So we're buying the 46, that's closer to the money, and selling the 47, and then the net cost of that is $40. And if you're selling a contract, it should say you're selling it, and then it will say you're getting a credit for it. Right. So you are actually now selling the better contract and buying the less valuable contract. And then that's what'll differentiate the two. So Margin versus cash account. Okay, so a lot of you guys know this that are in the Bueller's chat on a regular basis. If you're on a cash account, you can day trade all you want, but you can't do spreads. If you're on a margin account, you can do spreads, but you're subject to the PDT rule, which means no more than 3 round trips every 5 days. You can immediately utilize capital after closing a trade, and round trips on spreads only count as one day trade. So even though you're buying to open one position and selling to open another position at the exact same time, it's two positions. They only count it as one day trade. So that's kind of good to know if you start trading spreads and you're under 25K in your account. Um, for let's see, you can. This is a technique that you can use if you're on margin and you're not above 25K. You can open up a long position as a day trade, and then you can let that run according to your system. If you think that it's going to hit a rejection point, you can sell. You can leg into a spread at that point and sell a contract against your position. And then that will allow you to capture some of your profits and hold it overnight and not get hammered if there's a big drawdown. But you do not want to do this on same day contracts or next day contracts because you can get into trouble with that too. So you would only do this, a couple weeks out or 2 weeks out on contracts. You're just risking way too much to try and do this on next days or absolutely don't do it on same days. So cash, there's no PDT rule. You can't trade spreads, but you can trade cash secured puts. If you have a lot of cash in your account, you can trade spreads, but it's going to tie up a lot of your margin. And I wouldn't do that. If you have that kind of cash in your account, you should really just be on margin because you're probably over 25K. Um, Trade settlement for this. If you guys didn't know, there's kind of an interesting thing with this. If you're swing trading something and you close it the next day, the day after you open it, the capital is immediately available after if one day has passed. This is on TD Ameritrade, Tastyworks, and I don't know if it's on Webull and other places. It should all be the same, but I know that some of the other brokerages play with your money and hold it a little longer. Um, if you're on cash and you trade common stock, it's 2 business days for settlement. So most brokers require 2,000 at minimum to trade spreads. Tastyworks is the only one that I'm aware of that does not require that. I don't know if Robinhood does or not, but um, Tastyworks for sure is a great brokerage for trading spreads if you have a small account. All right, so quick overview. You already know some of this, right? Long calls, you buy them to open. It's a debit for the position, and you sell it to close it. Max profit infinite, and your max loss is just whatever you paid for that credit. And what helps this trade is fast upward price movement and an increase in IV. What hurts the trade is downward price movement, time, chopping sideways, and an IV decrease. Same with the long put, right? You buy it to open, it's a debit. You sell it to close, infinite profit, and your max loss is the initial debit. Fast downward price movement and IV increase helps this. And then the opposite of the call, upward price movement, time, and IV decrease hurts this trade. If you do any sort of long spread, you're going to buy to open the better position. You're going to buy to open the more valuable position, whether it's got more time on the contract or it's got a better strike price. You buy that, and then you sell to open the cheaper option position. So you're selling something with less time or a lower strike or both, or further out of the money strike, really. This will cost you money. You're going to buy it. You're going long that spread, so you will pay for it, and then you will sell it to close it, just like you would any of the other long positions. Your profit is relatively limited by the short contract price, and that just means that depending on how you set up the strategy, whether it's a calendar, diagonal, or vertical, and when you start hitting that short contract price, one of two things will happen. Your profit will either start to decelerate or it will actually start to get eaten up a little bit. So again, your initial debit is your max loss. And what's great about these spreads and any of these long options, right, rather than just trading underlying stock, You define how much your risk is. You can open up some of these long spreads for exactly your risk. If you're going by the golden rule of not trading more than risking more than 4% or 5% of your account per trade, you can construct a spread exactly so that it will only risk that amount for your account. And if you're working during the day and you don't have much time to manage it, these are a lot less susceptible to big drawdowns, and you can kind of set it and forget it if you construct it properly, and then just manage the close of it. So what helps this trade, the long spread? Steady or fast upward price movement helps. IV increase, same as this, but now you also have some steady movement. If you're just kind of catching a trend and it's slowly moving up, that's great for spreads. Downward price movement, longer times. You're buying a lot of time. You'll see on the next couple slides, you get a lot of time value out of doing spreads. And larger IV decreases because you're kind of offsetting some of these things. You're offsetting theta by selling a position. You're offsetting some IV by selling a position. Now, short spreads is the exact opposite of this. You're selling to open the better option. You're selling somebody the better, more valuable option, and you're buying the cheaper option, the less expensive option, and you'll receive a credit for this, and then you will buy it to close it. And your max profit on this, though, is your initial credit. So if you sold this spread for $100, the max you can absolutely make on it is $100, but you can lose a lot more on it. Price movement. This is more of a neutral trade, right? So price movement towards, sideways, or away from your short strike makes this a winning trade. IV decrease and time help the trade also. And then price movement past your short strike and an IV increase will actually hurt this trade. Here's your quick rundown on spread configs, right? Um, oops, let's go back. So verticals, you're selling the same expiration, but different strikes. Calendars, you're selling the same strike, but different expirations. And diagonals, you're combining both. General guidelines on these, the wider the strike of the spreads, the less protection and the more profit you make. So like if you buy a $5 call and sell a $20 call, it's a wide spread. Or if you buy a 5 and sell a 6 or whatever. If we're looking at Neo, which we'll look at later, if you sell a 40 and buy a 45, that's what we're talking about. We're talking about the width of the strikes. They're more expensive to trade, obviously, the wider you make those spreads because you're buying a more valuable spread closer to the money and selling something way out of the money. So that's how you kind of have to look at constructing your trades. The tighter the spreads, the better the protection and the hedge, but less profit. And then when you look at dates, it's the same thing. If you're setting up a calendar, if you're selling like really close to expiration and buying like a leap, essentially, you have a lot more potential for profit, but you're also limiting your hedge and increasing the cost of the trade. Uh, Often, when you're looking to trade calendars or diagonals, the monthly expirations have a lot more liquidity. But with these, a lot of the stocks that you see traded on Bueller's, they're all extremely liquid. So you can usually construct something decent for calendars and diagonals on the tickers that are on the watch list. So verticals, you're at the exact same time, you're simultaneously buying one strike and selling another. And this is one of the most basic strategies, building block for some of the more complicated stuff, like you hear iron condors and things like that. That's basically using different types of vertical spreads to create those strategies. Debit spreads on these are directional trades, and credit spreads are neutral, semi-directional trades. The benefits of these that you can basically trade some of these larger price tickers and some of the more highly volatile tickers and take advantage of the full move, but at a cheaper cost. And it also hedges your trade against large extended hour moves overnight because you're selling the same the same option contract on the same underlying as the one that you're buying. Um, and let's see when you can trade credits on these, but like I said, we're not going to cover that too much with this brief because it's more there's more risk involved with it. So for the calendar, you're simultaneously buying and selling the same strike, and then you're just picking two different expiration dates. So you might sell 2 weeks out and buy 4 weeks out, and then that would construct your calendar spread. At say on Neo, you pick the $50 spread, and you would do that. These are great for slower expected moves. I wouldn't typically trade this on highly volatile stocks, like biotechs that are going to be pumping news or anything like that, because this gamma works against you on this. And we'll cover that real quick too in another slide, because like I said, we'll go over Greeks real quick with this. But gamma works against you on this. This is good for low to mid IV trades. And the benefits, you can really use this to swing trade something very cheaply, and hedges against these extended hour moves the same as the vertical does. And theta works a lot more for you on these trades because you're selling that shorter expiration, and it can theta really crushes those front a month contracts pretty quickly. Um, Credit trades, don't mess with selling these as credits. Just don't do it. Diagonals. This is constructed by simultaneously buying and selling options of different strikes and different expirations. So you're selling somebody maybe on Neo, you're selling somebody like the say the 50 in like 2 weeks, and you're buying maybe the 45 in 4 weeks. So you're actually buying an at the money strike, and you've got extra time on it, and you're selling somebody an out of the money strike with less time on it. And so the benefit for this, I like these trades a lot. If I can set up a calendar on something that's liquid enough in the strikes that I want, I'll pick this typically over some of the other ones, because you take advantage of the vertical spread qualities, the benefits, the pros of this, and the pros of the calendar spread. It costs more to trade than a calendar spread and less than the vertical spread typically. Just depends on how you set it up. And then this is also your basic setup for the poor man's covered call or the synthetic covered call. We'll get into that. And then this calendar spread, if the price moves quickly through that short strike because it's so close to expiration, you can actually start to lose profit pretty quickly on calendars. And the diagonal can mitigate that if you have the spread set up properly. So, general rule of thumb is, if you have, say, a $5 spread and your cost for that spread is less, like $400, and you have a $500 spread, that pretty much cancels out the risk of gamma messing up your trade. So you'll understand that a little bit more as we move forward. So we're going to take a look at this example here. This is on Neo. This is, I think, about 2 weeks old now. Um, and if we think that if our thesis here is that it's catching support right at this 45 and we want to go long, we're going to take a look at the swinging a naked call at the money. And when we look at the trade, right, last time it was hitting, dropped off of all-time highs. It took probably about, 4 weeks, 4 or 5 weeks to recover and get back up to that point. So we're going to buy something, add a week or two to it because we're smart swing traders with options. So we're going to buy something 5 weeks to 6 weeks out. And a at the money contract naked is about $660 for a 57 delta. And then your theta is zero point 0.7. So this is $7 a day you're losing on this contract. And for every dollar it moves up or down, you make or lose $57. So we're looking at this, and a reasonable target, maybe up here in like the $52 range or $55 range might catch a bounce here and come up. So your return on capital in this trade at $60. So it actually comes up into this range up here. Your return on capital in 3 weeks is 109 to 138% profit. If we're wrong and it actually drops down into here and catches support around the $40 level and 41, in 3 weeks, we lose 50% to 80% of this trade. Okay. Um, Now, if we look at the vertical and we do the same thing, we're going to go 5 to 6 weeks out. We're going to buy to open the 16 April 46, right? So 16 April 46, and this is a vertical. So we're actually selling the same expiration, but a lesser valued contract at 55, because we want to take it a little bit wide, and we think that this 55 level is where it might catch a rejection too. So this trade costs you about $300 to open, and your net delta on it is 20, because the delta on the at the money is 57, and then the delta on the 55 is about 37, right? So that leaves you subtract the two, that leaves you about 20 for your delta, and you're actually very flat on theta. So that's good. So you can see, just by opening up the spread, you've essentially eliminated theta decay for the time being. So your return on capital at $60 with this trade in 3 weeks is 180 or is 80% up to 118%. So you can see you don't really lose a whole lot on the profit side of this. You're almost the same amount, right? You're 20% less ish. But this is 50% less to trade. It's over 50% less to trade. And if you look at if it drops down into this range, like we said, on this 40 mark, when 3 weeks, you're down 42% to 60%. So it's also helping you a lot with that. And we talked about this, right? You're wider the strike, the quicker the profit and loss, but the more expensive it is to trade and the less it hedges. On your long side, you can go in the money, at the money, or out of the money on the long strike. But the closer you get to expiration and the further in the money the short strike is, the quicker the profit will be capped. So depending on where you're buying this. If you go in the money and you only go a few strikes out of the money, and then you start getting, say you sold the or you bought the 42 in this range, so you're in the money, and you sold the 50. If it starts coming up into this range near expiration, you're going to really start capping your potential profit on this. So you just have to keep that in mind when you construct this based off your analysis. All right, so this is what you want to look at when this is what I look at anyways all the time when I'm opening up spreads is I look at how wide this is, right? And it just depends on this is why I said you've got to look at liquidity. You've got 122. Oops, let's go back. You got 122 on the downside of this, right? On the bid and 356 on the ask. So that's a huge spread. This is what $230 spread here on this. And I would just not trade this. There's a lot of potential for slippage because when you put this number in here in the middle, 239, yeah, you can buy in the mid, but all that money could come out of your long or it could come out of your short. You don't dictate where that comes out unless you buy these separately and create the spread manually. So I wouldn't trade that. Here's another example of bid and ask, and you can see this here. This is a negative 70 on this side and a positive 110. This means that there might not be any movement on one of these contracts, and it's actually a zero, or it's the spread is just massive. This is something that I would never trade either. Um, This one right here is actually a pretty decent setup because you're looking at something that's liquid enough that you only have between 240 and 260 for the spread. So you're literally right smack in the middle on that. That's awesome. This is the kind of thing that I look for when I'm trying to set up spreads. Okay. Um, let's see. So here's your vertical example. This is your naked call on the left here, and your on the right, this is your vertical spread that we just looked at. And so here's your theta curve on these two tickers or on these two different trades. This is theta on your naked position, and this is theta on your spread. See how it's almost flat, right? So if we look at the scenario on this, or actually let's look at this too, because this is what we said. What helps us trade is this fast upward movement, and this is a steady upward movement. See the green areas on these two charts is on the complete opposite. You flipped your profit potential on this all the way to the right on the spread, and then your loss area is massive on the um, naked side, and it's a lot tighter on the vertical side. So just this alone is a great visual of the benefit of trading spreads. So if we look at the scenario again, right, and we're bullish, we think that it's going to catch support here and come up, so we enter this position. But we'll look at a scenario here. What if it came down and caught support down here, took another leg down, and then chopped back up? So on the left side here, you've got it coming over a little bit, dropping down, and then coming back up. And after about 3 weeks or so, 4 weeks, you're at an $11 profit on a $660 outlay. $660 investment. Over here, with the exact same movement, you're at $91 profit. And the drawdown difference is about 12%. So you lost 44% over here. Likely would have cut it, right? But over here, you're at 31% drawdown. And the profit difference here, 1.6% profit versus 31% profit. So you're already at 10%, over 10% profit on this trade, even though it dropped and came back up. or sorry, yeah, 30% trade, my bad. Here's your 100% profit zones. So you see on this, you were literally chasing the 100% profit zone and kind of chasing theta the whole time. You're chasing profit. Over here, profit is just waiting for you. It's to for the price to move up towards it and go sideways even. And here's your 50% and above profit zone. So literally, if this moved up another 25, no, another $1.25 and went sideways, you could make 50% profit off this trade. And here you can see it's literally stepping up away from you as time goes by because theta is just working against you the whole time. So if we look at the calendar spread, calendars, general rule of thumb on these is you want the short expiration to be at least 2 weeks out. Ideally, probably about 3 weeks because there's more premium in this. There's more time premium in this that will get crushed as the weeks go by than in this. But you ideally want 2 to 3 weeks minimum for the short expiration, and then your strike prices they have to be out of the money. Depending on the TA, it might be the profit target. So if we think our profit target is up here at like 52 or 55, that's what we would be looking for opening the trade. So here we got the same exact naked position we would take as a comparison. And down here, we're going to swing the 16 April 55 call and sell to open the 9 April 55 call. So you're just changing the expiration and keeping the strike the same. And we picked the 55 as a decent round number. So it probably has more liquidity maybe than the 52. And that's also a good target for potential rejection. And it gives us some room for this trade to take place. So at $60, within 3 weeks, you're at about 20 to 55% profit, depending on how long it takes to get there. Obviously, a big difference in cost here between these two, but you're only putting out $63 to play this trade. So you're putting out less than 10% to take this trade, and you're making about 20% or more of what you would with this. So you can see there that your capital is working better for you. If it drops down to 40 within 3 weeks, you'll be at about a 28% loss to a 33% loss. And this is where I mentioned where you can actually construct this trade to just be your max risk on any trade. If you have a 5% risk on the trade, you could set it that you construct it so it's $63, or you could set it so that where your next leg down would be is what that loss is. So same profit chart, same scenario on the right. Now we have the calendar spread and the 63 cost. Goes through the same drawdown. You're only at 22% loss here, literally half the loss of this one. Look at this theta curve too. We've actually inversed it a little bit. And then up here, you're at 46% profit, $29. Doesn't seem like much, but you can trade the same size on this if you wanted to. If you have the account size and the risk tolerance to take a $660 trade, you can trade 10 of these, right? And then this is the 100% zone and the 50% profit zone. So literally, if this trade goes up a dollar, well, no, that's 75 cents, right? Let's see, $1.50 and just move sideways, you can make 50% off this trade. So here we went up about what $4 ish from the entry, 350, and you're already in solid profits on the trade, almost 50%. You're off by $1.50 or so. There's your 20% zone, profit zone. So literally 20%, if you're making 20% off every trade, you're killing it. And then a general rule of thumb, which you'll see with Harry too, is taking profits in the 20% zone, sometimes 50% zone. But you can see how easy it is to get into that profit area with these types of trades if you build them out right. And notice also how small this red area is. You could literally drop drop about $5 and just move sideways and only be at a $2 loss after a couple weeks. Let's see. So here's the diagonal. Same. We're going to look at the same naked position here, and then we're going to combine the two aspects of the short and the long. We are going to look at the 16 April 48, which is basically right at the money at the time of this. Well, a little bit out of the money. So when I did this chart, it was about 46. And then we're going to sell to open the 1 April, so shorter expiration and further out of the money strike. So we're selling the 50 right here, and we bought the 48. And then Same deal with the calendar as far as the expirations go. You want at least 2 to 3 weeks on the short strike, and the short strike price must be out of the money. Um, and then the spread between the long and the short should be greater than the debit. So, when I first started learning this, it took me a little while to understand. So this is a $2 spread, and the debit for this is 153. So that we're good. If we were at 253 on this, it's a less ideal setup because your debit is greater than the width of the spread. And all that does is help mitigate any gamma risks that we'll see with this. And I didn't actually explain that with this last one here. As you see, if you get you want slow, steady movements on the calendar. If you get a really fast upward movement on this, you can see you don't make hardly any money, even though it's hitting your target and doing what you wanted. And actually, you'll see here you're maxing out in here and then you actually lose money. And you'll notice the same thing over here. Your max profit is below your short strike. We were short the 55. So right in here is $233 profit off a $63 trade. But once you start going past that, it starts eating away at your profits. And that's gamma acceleration because that front month contract, the gamma accelerates faster on it, which cranks up the delta faster. So, and I'll show you a quick thing for that too. But that's what you're eliminating a little bit with the diagonal if you have this set up right. So here's your profit chart on the diagonal, $153 to trade this, and look at this theta curve. That's an amazing profit chart. You can literally drop about $5, $6 and just move sideways and make probably 20% off of this. So drawdown on this is 14% with the same movement and 87% profit. And then here's your 100% range, 100% plus, 50% plus, and then 20% plus. So yeah, drop $5 on the trade and move sideways, and you can still make 20% off of it. There's your 30% line. And so for diagonals, typically I'll look for 30% or more before I consider closing it. And then you can see also that you get better profit if you do get these quick upward movements, but it will still hurt you if it goes past your short strike because gamma is still going to accelerate and outpace your long option, your further out expiration, your back month. So this is a quick rundown on why this works, right? When you buy your naked at the money position, you've got this theta curve. And when you sell something a little further out of the money, the theta curve is actually worse. The further out of the money you are, the harder theta hits you. So you're selling this, but this is just comparing a vertical basically. And that's what flattens out your theta curve, like we saw in that previous chart. And your profit for the naked position is if the stock price goes down, and your profit for the long position is if it goes up. So that's why it flips these corners around completely for your profit, and it flattens out theta. And then the same thing on this profit, where if it took that dip down and came over, you can see you're in the money, you're making money off the short position and losing on the long, but the short is offsetting that long position. So in that example right there, right, you're at about well, that's wrong. Actually, it's $67 profit, about 25% because of the short leg. So this is really quick rundown on the delta and um, gamma ratios, right? So out of the money calls, and actually this is delta compared to theta. So if you're 1 week out on this call up here, and they're both the same, you don't have to look at the difference between the puts and the calls. So this is your 1 week contract that you're day trading, right? If you buy this contract and it's out of the money, the closer it gets to the money and on such a short expiration, you can see how rapidly it delta increases, and that's gamma acceleration. So this is what happens on your short contracts if you're selling if you're opening a calendar trade, or you're buying a diagonal or a calendar. That's where you can get that. If you get that quick, fast movement up towards the strike and through it, it can actually start eating away at your profits because you're on this one. You're on this blue line or the red line, right? You're a month out probably, and then this is a week out. So um, you can see your delta acceleration, your gamma acceleration, and your delta increase is much slower. And so that's why that can hurt you on calendars and diagonals. Yeah, the Greeks. Um, this is the gamma sensitivity to time, which is very similar to this that I showed you here. This is the delta, how the delta increases, and it's because of this. This is your gamma increase. This is 5 days to expiration, and if you're looking at a $25 dollar, uh, um, or no, probably a $24 delta or $24 strike on this. So 1 week to expiration, gamma cranks. 2 weeks out, you're still getting a decent push on it, but it's a lot less. And then, basically 3 weeks, 4 weeks out, you're much flatter. And so that's why your delta really starts cranking when you're closer to expiration because gamma just accelerates so fast. And then this is your strike price. So this is all getting really super nerdy. But if you look at the strike price, if $25 is at the money, right here, and $22 is in the money, then 28 is out of the money. So these are your different lines and how gamma, how fast it will move compared to the strikes. So you actually your gamma starts decelerating once you're in the money, and then once so if this is your long strike, if you went in the money, you can actually kind of limit yourself on the profit potential because of and you're out of the money. Short strike would start coming up and meeting in this point. That's when you'd start seeing your profit curves slow down. You're not losing money at this point. It's just slowing down your profit. And then theta, this is what's so huge on those charts, right? When you're 120 days out or 90 days out, this theta curve is very slow. And it starts accelerating when you get into the 45-day mark in here and really cranking down in the 30-day mark. So if you look at this on your calendar, you're buying this contract about, say, 4 weeks out, 5 weeks out, and then you're selling something that's maybe 3 weeks out, and then literally as the price moves forward, time moves forward, sorry, your contracts decay that much time. So with that same amount of price movement, that's where you can make your profit on those diagonals and on the calendars, right? So quick summary on this, you got your verticals that we talked about. Basically your pros is it significantly flattens theta. It helps counter IV and it flips the profit timeline almost, or completely so that you're not chasing profit. Uh, and then it allows you to still take advantage of the full underlying move if it's too expensive for you to trade normally and you want to try and lower it. You could trade some tickers that are a little more expensive by doing verticals just to lower the cost of entry and still take advantage of a good setup on something that's priced, too high. The cons is it can cap some of your upside potential. It's still a relatively linear profit chart, meaning you still have to move in the direction that you want to move in, that your thesis is to make your money. If you just move sideways, eventually you're going to lose money, or if you drop and move sideways. Um, and it still can be quite pricey depending on what you're going at. But you know, there's your 100% plus profit zones again. And then the same thing with the calendar, right? Slightly inverses the theta curve and the loss curve, so you can take a little bit of a hit on this and still be profitable. Um, and then it increases these profit zones significantly. If you're just looking for 20% profits on decent setups, these are very cheap ways to play that and increase your account. This definitely caps your upside potential, especially on quick movements up, right? You can see that you're not making hardly any money off of these with these quick movements, and you're actually losing money if you go past this short strike out here. Whereas on the vertical, you will just level out for a little bit and then start to lose money. And then a diagonal, you set it up right, it basically completely inverses this theta curve. And then again, increases these profit zones. It's very easy to achieve these if you have good technical analysis and you're constructing these properly. It's pretty easy to hit 20% profits on these. And the biggest con with these is the same as the calendar, and that you're paying more to benefit from the pros of the vertical and the calendar combined, basically. So all of that stuff said is a lot. That was the fire hose. The diagonal, like I said, I've been trading these synthetic cover calls for a little while. I like them. It's a good way to take advantage of solid ticker setups on accounts that and it's also just a very efficient way to take advantage of them too. If you're buying stocks, I'll show you the comparison with this. If you're buying 100 shares, you can sell calls against your position. right? So if there's a solid ticker that you like that took a recent dip off of some news or just an overreaction, you can buy leaps and just hold, right, to take advantage of that dip. You can just trade it, swing trade it with naked calls. Hopefully, after I just showed you those profit curves, you'll think about constructing spreads instead. Or you can set up one of these spreads that we just covered, and then to set up a synthetic covered call, you're essentially going long out on expiration and at the money or in the money for the contracts, and then you're selling front month strikes as at likely resistant points, and then you're just rinsing and repeating that process. So um, you can let those front months expire worthless. I typically close them if they're hitting 50% profit or more, or if it looks like it's something's going to catch a support and move up again. So we'll look at Intel, and I'm still in this trade right now. Uh, and this is what happened essentially. I didn't. Well, there's your spoiler alert. So there was a big bump up here on news. I think Intel said they were going to outsource their production because they've been beaten down off of not being able to meet their delivery requirements. So they jumped up here. It kind of consolidated a bit, dojied out on this day and looked strong. I liked how the setup was because we were coming up on earnings, and the front month contracts that were coming through earnings were actually pretty juiced up. So I picked up this position here, bought to open the 16 April. And so we were, I don't know where this was, what time frame that was on. But I bought to open the 16 April. I think we had 4 months or 5 months on that contract. Yeah, let's see. I opened it on, I say right there. Yeah, January 19th. So yeah, about 4 months on that position. Bought the 57.50, which was right at the money, at $400, and then sold the 61 call at 105. And I sold the 61 based off of some gap that was back here. So you can see it did really well with the earnings report, spiked up, and the volatility. It didn't hit the expected move, and the volatility got crushed, and then it sold off down into this range here. And so um, what I did with this was close the position at, I think, almost 90% profit, or close to 100% profit. So I closed it for $5 because I expected it to catch some support in here, and I was waiting for another opportunity to sell against it again. And then so that created my total debit here was 295 to trade. So by closing that for $5, I paid $5 to close it. That brings my debit to $300 for that long position, right? So now I'm in this long position for a 30% or 25% discount essentially. So as it pumped up into this area and there was a resistance in here, like a 1 hour zone that I saw, and you can see it wicking off those perfectly. As it pushed into that, I sold again, and I sold a 12 February 59 call. So I went up to here where I expected that it would probably reject off of this wick. Um, and I sold it for $64. And so you can see it moved up against that position. So I sold it down here for 64. In here I was probably red on the trade. It was probably showing a loss on the trade because that call was more valuable. But up here, just by letting time chew away at that, theta crush it. Remember that line I showed you? I sold somebody that 45-degree curve on theta, and I bought it back for about 30% profit here, about $22. So or $20. So that lowered the cost to own this again. And then right here, as it pushed up into this zone, I sold. You can see I'm just selling a little further out expiration and a little higher out of the money strike. So I sold that for 55 at that point, and I sold at 62.50 up in this range here, where I figured it would also be some solid resistance. And then I closed that on this day here as it came back down, and I closed that for close to 50% profit ish. So you can see it's just slowly chipping away at my cost to own this, and I'm not even looking yet at how much this has increased in value from the entry point. So then again, as it pumped up towards that 62.50, it sold again 5 March 64.50 for $46. And then I closed that over here as it pulled back because it looked like it was kind of getting a little bullish on this. It was going to potentially pump. And we all know, well, afterwards that this actually sold off with the Qs and kind of came back down in close to my entry point. But What happened with this here, I closed that for about 60% profit, $30 or so. Um, so the cost to own this is now at 228. And so as you look at this, each time you're trading this, it's 25% credit off of that, 30% credit, 36% credit. I'm at 43% credit on this position. So so far up until the date that I did this, the synthetic covered call was at 93% profit as of 2 March, right? The underlying trade, if you let me put this up here. If you just bought the leap alone and held it, you'd be at 50% profit at this point. But because of selling the covered calls against it, I was at 93% profit. And if you took this as an underlying common stock trade, you bought it here, you'd put 5,700 bucks out for that trade to buy 100 shares, and then you would have made about 500 bucks off the underlying movement, right? Because it moved about $5. And then you would have made another $172 off these credits. And so your profit would have been about 12%. But if you just bought the underlying and held it and just sat on it, you'd be about 9%. So it doesn't look like a huge difference for some of the work that you're doing, but this really theta is doing all this work for you. When you go to sleep at night, theta just literally robs that number out of those contracts and puts it in your pocket. So 3% realized over 45 days is probably about 24% additional profit you'd make off of this across the year. And that's regardless of the drawdowns, right? So um, that's pretty much it for that one. So when you look at this for managing these, a lot of people get scared with this because as soon as you sell these positions, right? As soon as you sell this, I sold this 105, right? Over here, I sold the 61 for 105. On this day, this was probably $100 loss that it looked like in my portfolio, right? That contract was probably worth now $200. But what you have to keep in mind, what none of the platforms show, I think Tastyworks is starting to integrate this now. Um, None of the platforms show is that that initial credit goes right into your account statement. That literally puts $100 into your account as soon as you do it. Now, um, it's realized in this trade because the trade just costs you less. But if this trade is at a $100 loss, it's not counting the fact that you had a $100 credit. So you can close it at that point for zero gain, zero loss. But you want theta to do its thing and the price action to do its thing, and IV also to get crushed on those contracts. And the further out contracts have less IV fluctuation on them. So me buying this close to earnings might have seen maybe a 5% drop in IV, but this probably saw a 15, 18% drop in IV, which is just why so quickly I could close it for 100% profit. Um, so for managing these, that I said all that to let you know, like you could sell something and pretty much immediately it'll look like you're losing money on it because the stock price will go up, right? You want the stock price to go up. That's what you're trading for. You're in this as a synthetic covered call, or you bought stock back here. But as soon as you sell an option against it, a call against it, it's gonna go red unless it drops off immediately. So that's bad for your long position, but good for your short position. So if this is pushing up, say I didn't sell the 64.50 over here, I sold the 62.50, and now I'm in the money like I was over here, and I'm concerned about it because it expires in a couple of days. You have some options to look at with this, right? Um, when you look at the option chain, um, you say we were right here at the 63. You can see that it's worth $82, and I probably sold it for 40ish. If that was the scenario. Um, when you get that upward movement on these stocks, like I said before, you get that gamma acceleration, and you can typically you can take advantage of that by just rolling it out because this will experience some gamma acceleration at the same time. So, say you were concerned that this was going to go in the money and stay in the money, and you didn't want to close out of your position, you could actually roll it out and up is what they call it, out and up. So we're at the 63 strike here, and you could roll it to the 64 1 week out. And you can see here, the midpoint for this is $90, and the midpoint for this is 86. So you would actually get an additional $4 credit and another dollar of buffer if you thought that it would be more likely to reject at 64 or not breach 64 in another week. You could do that too as kind of a safety net for your trade. And you'd still keep that initial credit that you got on this to lower your cost of entry. So you just would have to keep an eye on it. But personally, with this, there's 4 days left. If you look at theta and delta on this, you've got your theta at -10 and delta at +48. So that's that 45-degree curve, right? So um, theta is your friend when you're short on these things. So I would personally probably, well, I would personally, if I was in this position, you can see here, I was actually long this one, the 6450. So I wasn't worried about it, or I was short the 6450, sorry. I would just let this sit and let theta do its thing because you'd always be able to roll this out if you needed to, out and up. You have some time left on it, and up until the day of expiration, you have room to move these things. Um, so if we look at what happened next, the very next day, it rejected something in here. This might have been the start of the Qs selling off, and immediately you can see what happened to the strike price on this. Where'd this go? All right. I guess I got messed up, but you can see on the next day. Oh, maybe it did do it. Yeah. Sorry. It's Q sold off a little bit, and you can see now that the cost of this dropped back down to 45. And so rolling it up and out now wouldn't get you anything on it, but you're out of the money another 50 cents at least. And it cut this in half, and you see it also lowered your delta, but theta stayed the same. So theta is your friend when you're short. So I would just kind of sit on these things and let them play out. If you're in leaps or if you're in leaps, definitely, I don't sit and hold any leaps anymore. I sell against them at least to eliminate theta. And if you're on underlying stock, you can do the same as covered calls, but you're not eliminating theta. Obviously, you're just lowering the cost to own the stock. So there's a lot of places out there, like Tastyworks is one of them, that just even looks at the delta on these things and doesn't they don't look at charts at all. So let's say you're long the 60 call out in October and it's at 8:15, say 8:10ish. There's not much theta on this. It's -$1 a day, but when you look at it across, you're going to hold this for 227 days. That's $227. Well, it's more than that because theta is going to accelerate, right? You remember those graphs that we talked through real quick. Um, uh, So you can pretty easily with this eliminate theta when you come down in oh sorry when you come down into here you're looking at theta accelerating. It's $5 a day on that same strike at 60. You can easily kind of compare what will happen to your leaps as they get closer to expiration. So at minimum, I'll go in and just look at the deltas on these things, and you can look at the expected move up here on TOS and on Tastyworks. You can see the expected moves. You have to research this. Tastyworks does this calculation a little different. TOS, this is the expected move for the contract, and you can easily take that, and that's 270. So you go up from here, $2.70. The market makers expect that Intel could move up to say $65 as a max move for this week without any kind of catalyst. And you can just sell two, three, four strikes above that. You're not going to make much money off of these, but this is $10. And the delta on this is a lot of tasty workers look at this and go, this is your probability that it's going to be in the money. This is an 8% chance that it's going to be in the money. It's not exact, but it's a pretty good ballpark. So 8% chance that this will be in the money. You can sell that for very little risk against your leaps or against your stock, your underlying stock, and that's $10. So you just knock 10 days of delta off of that position of delta or of theta decay. Sorry, and that's basically it. The way that I was doing the covered calls or the synthetic covered calls is I was selling them a little bit more aggressively close to these resistance points that I was talking through on the chart. So I think that's it, man. Did I miss anything, Bueller? That's quite the. Um, yeah, I'm happy to help answer questions for the profit charts. Let me pull this up here. You can I use that options profit calculator, and it's really easy to Really easy to set these up. You can come in here and do a calendar spread. And if we look at, let me look at, actually, I can look at Pinterest because I was liking that to set up. I picked up that today as a synthetic.
Jesus, look at your
Um,
current calculations.
but yeah, these are all things that I've looked at recently. It's a great site. You kind of got to play around with it a little bit, but um, I was liking Pinterest. I was watching it down here as it dumped off. I traded it through earnings and into earnings, and then sold it out somewhere up in here. Um, I think I was watching this. This is just I just opened up the paper account here, but so I don't have any of my charting done on it. But I was watching this area right there for catching a bounce, and it looks strong. And see this big wick today. I like that. So when it was dojied today, I picked up a setup for the synthetic that I had posted in my channel. So I picked up basically right here at this point. Um, and all you have to do with this is I forget what I had. I think I sold the 76 and I bought the 75. So, but I did. You can just go in here and do. Oh, this is for calendar. Well, that doesn't matter. Put in the ticker, get the price. And then your back month option by, I think, what did I do? June. I believe I did June 75 at the midpoint. I'll show you that real quick because I went through that quick. And then the one that I wrote was, I believe I did the 26 March at 76. And so this is the bid, the mid, and the ask. So I always do the mid. And that's why I showed you those, that quick little window on the bid ask spread. So these are, you can see these are pretty decent. 236 ask, 221 bid, and 229 in the middle. So $700-ish debit, and then just hit calculate. So there's your chart. Look at that theta curve. That's beautiful. So literally, so this isn't, the intent of this isn't to trade this as a single unit and then just roll out of it with profit. I'm going to let this run a little bit and then close out this short leg for 50% plus profit, and then just keep rolling with it like I showed you with Intel. Let's see.
And then Apex asked you a question too.
I see this. Tighter spread for diagonals, calendars. Oh, for diagonals, really. So for calendars, it's the exact same thing. So we can look at this. You're doing the exact same strike for calendars. And so, oh, whoops, I did the exact same strike on this. I got to do the 76 on this one. Yeah, it was about 700 when I did it though. So yeah, you can see. So that's the diagonal setup. The one that I just showed you was the calendar. So for calendars, you buy the exact same strike. For this isn't a good example because I'm showing you my initial entry for a synthetic covered call, and then I'm going to continue to roll against this. So I'm going to have to manage this a little bit more than I would just a regular diagonal. But say we're bullish on pins, right? And we want this short-term target. If we look in, let's look at like the hourly real quick and go, okay, you know what? This is like, it's going to catch a rejection in here probably. 74, 75, and then look at this 3-bar play down in the 1 hour. That's beautiful. So it's going to reject there too. All right, so we could go calendar on this at 78, or we could do maybe a 76, 78 for a diagonal. Let's look at the 76, 78 diagonal for like a swing trade. Um, and we will sell, let's go April, oops, I'm going to go April 16th for our long side, and we can only do 75. So yeah, we'll do 75. Okay. And then for the short leg, we'll go April 1st and we'll go 78. Okay. So we've got a $3 spread and the net debit is 240. That's your general rule of thumb. $3 spread and we're paying less than $3 for it. So that's kind of the general rule of thumb. We'll take a look at that. So that's a pretty decent looking profit chart. Even if it takes a leg down to 71 and goes sideways for 2 weeks, you're at 0% loss. Does that answer the question, Apex? I think that's what you were asking. And if you looked at the calendar on this, it's just straight. This is the exact same strikes. You know, awesome. So Tysonia, dividend risk for covered calls. It's typically it gets really into the weeds on this, and it depends on what you're selling against and what your concern or care about that underlying is. If you're okay with getting assigned on that, like you can do covered calls immediately upon entering a trade, upon buying underlying stock. So say you're long pins and you bought it down here at this dip at 62 and you're fine with selling it at 75. If you, or let's say you're over here at 71. Hold on one second. All right. So say you sold to 70, let's say you sold even the 72, yeah, and you're in the money now. If you're okay with getting assigned on that because you bought it down here at 62 and that's a $1,000 profit off 100 shares plus whatever you sold the call for, then you just let it go even if it's coming up on dividends. But if you're in the money, or if say you're at 73 on your short and dividends are $1 on this on pins, they take that out of the stock price, and so it can actually make it more likely that you'd get assigned. But honestly, I would read articles about that. They'll be able to explain it better than I can, and it is a risk, but it's usually only if you are in the money, and the cost to buy a cheap put to hedge that stock position is the same as the profit that they would get off the dividend by exercising the contract. So it's kind of complicated and it's not super, super common, but I'd recommend just reading an article about it. Sorry. It's a little more to go into than I can explain now, but um, let's, oh, did we? Yeah, we looked at that. Okay. Um, Yeah, that's it. I mean, I like the calendars. I like the diagonals. I like the diagonals a little better, but they're not always easy to set up. Let me see if I can. Thought I had that open somewhere. I like setting up the calendars on Tastyworks too because it's click and it's easy to um, set them up. You just click them on TOS on the mobile or on the desktop app. It is a pain in the butt to set up diagonals and spreads and stuff. All right. Any other questions?
Yep, that's it. I think everybody's ready to wrap up their evening.
Yeah. All right. Cool. Well, yeah, shoot me a DM if you guys got questions, and I'll do my best to get back to you. I'm not always on like during market hours, but the it just depends on what my work schedule's like. And
And of course, thank you, Tinman, for taking the time to make the presentation as well as keep fixing it. Because this is the third time he's given it. He gave it to me. He gave it to Ryuk. I'm sure he gave it to the mods and analyst, and now here he is giving it again. So, I really do appreciate him and all that and all his hard work. Hard work. So, thank you, Tinman.
yeah, absolutely, man. This is a great team. I love helping out, and like I said, this stuff takes a long time to figure out. So if we can help other people that are new get some knowledge real quick, that's awesome.
Definitely.
Pay it forward.